Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Imagine earning money while you sleep, not through a side hustle, but by simply understanding how financial instruments called bonds can generate predictable income. Today, we're demystifying bond income generation, transforming what sounds like complex financial jargon into a practical roadmap for anyone wanting more financial stability.
Wait, so bonds aren't just those boring investments my grandparents talked about. How realistic is it for someone in their 30s or 40s to actually create meaningful income streams using bonds?
Great question. What most people don't realize is that modern bond strategies can generate income that's not just reliable, but potentially competitive with other investment approaches. We'll break down exactly how different bond types can function like financial utility vehicles, generating consistent cash flow with varying risk profiles that can be tailored to individual financial goals.
Welcome to our deep dive into bond income generation strategies. Let's examine how to construct a bond portfolio that aligns with your financial goals.
Absolutely. Building a well-designed bond portfolio is crucial for success. It's not just about picking individual bonds, but strategically combining them to maximize income while managing risks.
I remember last time we mentioned terms like laddering and barbells. Are those specific portfolio construction techniques?
Great memory. Yes, laddering and barbells are two common approaches. Let's unpack each one.
Laddering is a technique where you build a portfolio with bonds that have staggered maturity dates. Picture the rungs of a ladder, with each step representing bonds maturing at regular intervals. This offers several advantages.
Oh, I think I see. So rather than having all your bonds mature at once, you spread it out. What's the benefit there?
Laddering provides a few key benefits. First, you get regular opportunities to reinvest proceeds as bonds mature. This helps manage interest rate risk because you're not locking everything in at one rate. It also provides a more consistent income stream since you'll have bonds paying out at each step. Finally, the staggered maturities create a naturally self-rebalancing portfolio.
So, laddering helps on multiple fronts, providing flexibility, risk management, and reliable cash flow. What about this other strategy, the barbell?
The barbell approach is a bit different. Here, you concentrate your portfolio at two extremes, long-term bonds and short-term bonds, with less in the middle. Imagine a barbell with weights on each end. The goal is to maximize yield potential with the long-term holdings while maintaining flexibility with the short-term portion.
Interesting. So you're balancing reward and responsiveness in a sense. What's the advantage compared to laddering?
The barbell strategy can offer higher yield opportunities since you're locking in more long-term rates. It also allows flexibility to quickly reinvest the short-term portion if rates rise. The trade-off is you may have less predictable income compared to laddering. It's really about strategic exposure to different parts of the yield curve.
This highlights how bond portfolio construction involves balancing priorities and risks. Speaking of risk, what are some key factors to monitor there?
Definitely. Two big ones are duration and credit risk. Duration basically measures a bond's sensitivity to interest rate changes. Higher duration means more price variability as rates move. Portfolios can adjust their duration exposure based on interest rate outlooks.
And credit risk is about the bond issuer's ability to repay, right? How do you manage that?
Exactly. Credit analysis and diversification are important. You want exposure to high-quality issuers while not being overly concentrated in any single name. Active management can help identify and adapt to credit risks.
This really underscores how bond income investing requires vigilance. It's not just set it and forget it. Investors need to monitor risks and adjust their approach as conditions evolve.
Definitely. I'm seeing how having a clear strategy while staying flexible, is so important with bonds. It's a balance of generating consistent income and adapting to change.
Let's bring all this together with a quick recap. We've explored how laddering and barbells represent two key portfolio construction techniques for bond income. Laddering focuses on creating a steady, predictable income stream by staggering maturities. Barbells aim for higher yield potential by balancing long-term and short-term holdings.
Right, and both approaches require actively managing risks like duration and credit quality. It's not just a one-time setup.
Absolutely. Effective bond income investing involves ongoing monitoring and adjustment. This includes regularly assessing economic conditions, interest rate outlooks, and issuer fundamentals. Portfolios may need to adapt their duration positioning or sector allocations as the environment evolves.
That's a great point about adaptability. It raises the question, how can investors strike the right balance between maintaining a consistent strategy and responding to market changes?
It's a delicate balance. On one hand, having a clear investment philosophy and process is crucial for long-term discipline. Chasing short-term trends can lead to suboptimal decisions. On the other hand, rigidly adhering to a strategy despite shifting fundamentals can introduce unnecessary risks. The key is to have a robust framework for evaluating when tactical adjustments are warranted.
So it's about proactively managing the portfolio within a structured approach, rather than either completely reshuffling or not making any changes at all. What might be some examples of conditions that would prompt an adjustment?
Some potential catalysts could include significant shifts in the interest rate outlook, changes in the credit cycle, or relative value disparities between sectors. For instance, if the economy is showing signs of weakening, it may be prudent to upgrade credit quality and shorten duration. Alternatively, if yield spreads widen to historically attractive levels in a specific sector, targeted allocations could add value. The through line is always making judicious adjustments to optimize reward for risk.
What would be one key piece of advice for investors looking to generate reliable income through bonds?
Focus on developing a clear, goals-based investment plan. Start by defining your income needs, risk tolerance, and time horizon. Use this to inform your strategic asset allocation and portfolio construction approach. Then, implement your portfolio with an emphasis on diversification, risk management, and cost efficiency. Finally, commit to regularly reviewing your portfolio and making adjustments as needed within this framework. Taking a disciplined, investor-centric approach is vital for long-term success.
Sage advice, thank you. Building on that, I'm curious to explore how investors can think about duration specifically as a risk management tool. What role does duration play in navigating changing interest rate environments?
Duration is a key lever for managing a bond portfolio's sensitivity to interest rate movements. In simple terms, duration measures how much a bond's price is likely to change given a shift in rates. Longer duration bonds will see larger price swings, while shorter duration bonds are more insulated. So in a rising rate environment, shortening portfolio duration can help mitigate price declines. The trade-off is giving up some yield, since shorter-term bonds usually have lower coupons. In a falling rate scenario, extending duration can boost price appreciation potential. The decision ultimately comes down to balancing income goals, total return objectives, and risk tolerance.
That makes sense conceptually. What might be a real-world example of how an investor could adjust duration positioning?
Let's say an investor has a bond ladder with maturities ranging from 1 to 10 years. If their analysis suggests rates are likely to rise, they could reallocate some of the longer-dated proceeds into the shorter end of the ladder as bonds mature. This would bring the overall portfolio duration down without having to sell longer-term holdings at a loss. Alternatively, they could employ a barbell strategy, concentrating maturities in the very short-term and longer-term segments. This provides a blend of stability from the short end and income generation from the long end. The relative weights can then be adjusted based on the rate outlook.
Those are great illustrations of duration management in action. It also highlights how having a clear portfolio structure in place, whether a ladder or a barbell, creates a useful framework for making tactical shifts. To zoom out a bit, what would you say is the most important thing for investors to keep in mind when it comes to duration decisions?
The key is to always anchor duration positioning in your broader investment objectives and constraints. Don't take on more interest rate risk than is necessary to meet your income and total return goals. At the same time, don't become so defensive that you end up sacrificing too much yield and undermine your long-term plan. It's also critical to remember that duration is just one piece of the puzzle. Credit risk, curve positioning, sector allocation, and security selection all need to be managed in concert. The goal is to construct a resilient portfolio that can deliver consistent income across a range of market environments.
It strikes me that this is where having a well-defined investment process becomes so valuable. By establishing clear parameters around each of those risk dimensions, investors can create a roadmap for navigating changing markets. The process provides the discipline to make judicious adjustments rather than getting caught up in emotion or short-term noise.
I think that's an insightful synthesis. At the end of the day, successful bond investing is about judicious risk-taking in the pursuit of reliable income. By developing a robust framework, investors can chart a steady course through the inevitable market ups and downs. As we close out this segment, what are a few key takeaways for our listeners?
First, effective bond income investing requires an intentional approach to portfolio construction. Techniques like laddering and barbells provide useful starting points for generating consistent income and managing risks. Second, an investor's strategic asset allocation should reflect their unique objectives and constraints. Make sure your duration profile and risk exposures are appropriate for your circumstances. Finally, stay focused on executing your investment process rather than reacting to short-term volatility. Have a disciplined approach for making tactical adjustments, but don't lose sight of the long-term plan.
Wonderful advice. Thank you both for sharing your insights. Building on that helpful overview of duration management, I'd like to zoom out a bit and look at the broader bond income landscape. There are many different types of bonds investors can choose from to meet their income goals. What are some of the key sectors, and how do they compare in terms of their risk-return profiles?
When constructing a bond income portfolio, investors have a range of options across the credit quality and geographical spectrums. On the highest quality end, there are government-backed agency bonds that offer moderate yields and low credit risk. Investment-grade corporate bonds provide a balance of reasonable income and safety, while high-yield corporates dial up the income potential, but with greater risks. There are also floating-rate bonds that offer variable payments based on reference rates. Geographically, developed market international bonds can offer diversified income streams, although currency risks need to be considered. Emerging markets bonds tend to have higher yields, but also greater economic and political risks. Some investors use global bond strategies to get diversified exposure across multiple regions in one portfolio.
So it seems like moving up in credit risk or exploring international markets could boost income, but those come with trade-offs. How can investors think about balancing those risks and rewards to meet their goals?
That's a key question. It ultimately comes down to each investor's unique objectives, risk tolerance, and constraints. The goal is to take on the right amount of credit and international risk to generate the necessary income, but not more than that. A core principle is diversification both across and within sectors. So rather than making concentrated bets, investors can add measured exposures to riskier categories like high yield or emerging markets to complement a core of high-quality holdings. Diversifying across issuers, industries, and countries is also important to manage idiosyncratic risks. Active management can add value by tactically shifting these exposures based on the market environment. But the strategic framework should be grounded in an investor's specific circumstances.
That's a helpful way to frame it, being intentional about the risks you're taking to achieve your income goals. Maybe you could share an example of how an investor might go about building an income-focused portfolio with that in mind.
Let's consider a retiree who needs to generate a predictable income stream while preserving capital. One approach would be to build a laddered portfolio of high-quality bonds, let's say rungs from 1 to 10 years. This would create a structure for regular reinvestment as bonds mature, reducing interest rate risk and providing consistent income. To boost the income potential, the investor could consider adding some carefully selected corporate bonds at the longer end of the ladder. Investment-grade issues could enhance yield without taking on too much incremental risk, and perhaps a small slice of high yield could be added for a bit more income, but sized appropriately and diversified across issuers. On the international side, a diversified developed markets fund could broaden the opportunity set, but the currency risks would need to be evaluated in the context of the investor's total situation.
That latter structure seems to provide a helpful framework for generating steady income and managing risks. But what happens if rates move higher? Wouldn't the portfolio lose value?
You've identified a key risk that all bond investors need to manage. If rates rise, the value of existing bonds typically declines, all else equal. But a ladder provides some natural defense by allowing maturing proceeds to be reinvested at higher rates. And the income generation remains constant, which is ultimately what matters most for this retiree's goals. That said, the investor could also actively manage the ladder's duration profile based on their interest rate outlook. If rates are expected to rise, they could temporarily shorten the ladder to reduce price sensitivity.
This example illustrates how having a thoughtful portfolio structure can create a foundation for generating reliable income and weathering changing market environments. By combining diversified sector exposures and risk management techniques like laddering, investors can position for consistent income across a variety of scenarios.
Absolutely. And it highlights how bond income investing is ultimately a risk management exercise. The key is to build a resilient portfolio that balances income generation with capital preservation and that aligns with an investor's specific goals and constraints.
As we wrap up this segment, what's one key thing you'd like our listeners to take away?
Focus on creating a high-quality, diversified bond portfolio that delivers the income you need to support your goals. Be intentional about the risks you're taking and make sure you're being adequately compensated. And maintain a disciplined approach that keeps you anchored to your long-term plan, even as markets ebb and flow.
That's helpful advice. I'm walking away with a better understanding of the key building blocks of bond income and a framework for putting the pieces together in a goals-based portfolio. I feel more equipped to make informed investment decisions.
So we've covered the key mechanics of bond income and some important risk considerations. As we start to think about putting these concepts into practice, let's talk about laddering and barbells one more time, but in more depth this time.
There are a few key portfolio construction techniques that can help investors generate reliable income streams while managing risks. One common approach is laddering, which involves building a portfolio with bonds that mature at regular intervals, like the rungs of a ladder. This creates a structure for consistent reinvestment of proceeds as bonds mature. It helps reduce interest rate risk since only a portion of the portfolio will be reinvested if rates change, and it can provide a steady income stream, almost like creating your own bond income annuity.
That latter concept makes sense, spreading out the maturities to smooth things out over time. But how would an investor actually go about building a laddered portfolio? What are the steps involved?
To construct a basic ladder, you'd start by deciding on the overall maturity range, let's say 1 to 10 years. Then you divide your portfolio into equal parts, like 10 slices, and invest each part in a bond maturing in a different year. So you might have bonds maturing in 1 year, 2 years, 3 years, and so on up to 10 years. As each rung of the ladder comes due, you'd reinvest the proceeds in a new, longer-dated bond at the top end of your range. So in this case, as the 1-year bond matures, you'd use that money to buy a new 10-year bond. This keeps the ladder going indefinitely.
I can see how this approach would provide a helpful structure for income planning. But going back to our earlier risk discussion, how does laddering affect a portfolio's sensitivity to interest rates? It seems like it would still have exposure, especially with longer-dated bonds.
You're right that laddering doesn't eliminate interest rate risk. The portfolio's value will still fluctuate as rates move, especially at the longer end of the ladder. But the laddered approach does provide some built-in defenses. First, the regular reinvestment of maturing bonds helps offset price declines. If rates rise, investors can take advantage by reinvesting proceeds at higher yields. Of course, the opposite is true as well. If rates fall, new bonds will have lower yields. But this diversification across maturities helps smooth out the overall impact. Investors can also actively manage their ladder's duration or interest rate sensitivity based on their market outlook. If they expect rates to rise, they might temporarily shorten the maturity range, selling longer-dated rungs and reinvesting in shorter-term bonds. This would reduce the portfolio's overall price volatility. The ladder structure makes these adjustments easier to implement.
That's a helpful explanation of how laddering can fit into an overall risk management approach. But what if an investor is willing to take on a bit more risk to potentially boost their income? Are there ways to modify the ladder strategy?
Definitely. For investors with a higher risk tolerance, there are a couple key ways to adapt the laddering approach to enhance yield potential. One option is to incorporate lower credit quality bonds into the ladder, particularly at the longer dated end. Investment-grade corporate bonds tend to offer higher yields than government securities, albeit with somewhat higher credit risk. An investor could build a ladder with the shorter rungs in treasuries and then add corporate bond exposure in the later years. It's important to diversify these corporate bonds across issuers and sectors to mitigate default risk, and investors should make sure they are being adequately compensated for the additional risk. Another yield-enhancing tweak is to use a barbell strategy within the ladder. This means concentrating maturities at the short and long ends of the range, creating a barbell shape. The shorter-term bonds provide stability and reinvestment opportunities, while the longer-dated issues offer higher yield potential. This approach introduces more price volatility than a straight ladder, but it can make sense for investors who can tolerate that risk. Again, diversification is key to managing the overall portfolio impact.
These adaptations highlight how laddering can be a flexible tool for income-focused investors. It provides a blueprint for generating consistent cash flows, but it can be customized based on an investor's specific goals and constraints. As we wrap up our discussion of bond income strategies, what's the key takeaway you'd like to leave our listeners with?
The most important thing is to develop a thoughtful, goals-based investment plan and stay disciplined over time. There's no one-size-fits-all solution, but techniques like laddering can provide a helpful structure for generating income and managing risks. Investors should focus on building diversified portfolios across maturities, sectors, and geographies. They should be deliberate about the risks they are taking and make sure they are being appropriately compensated. And they shouldn't be afraid to make tactical adjustments based on their evolving needs and the market environment. But these shorter-term moves should be made within the context of a robust, long-term strategy. Ultimately, successful bond income investing is about striking the right balance between generating consistent cash flows and preserving capital. With a prudent approach, investors can create durable income streams to support their financial goals in any market.
A valuable perspective. With that, let's wrap up this segment on bond income strategies. To recap, we've walked through the key mechanics of bond investing, common risk factors, and portfolio construction techniques like laddering. What we've seen is that generating reliable income requires an intentional approach informed by an investor's unique goals, time frame, and risk tolerance. By understanding the core concepts and implementing thoughtful portfolio strategies, investors can position themselves to harvest bond income streams through a variety of market environments. We hope this discussion has equipped our listeners with a solid foundation for evaluating and implementing bond income strategies. Join us next time as we dive into Treasury bonds. Until then, stay focused on your goals and happy investing.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.